Hi, everyone. Welcome to this wealthmanagement.com Fast Chat. I'm David Armstrong, the executive editor of wealthmanagement.com. Today, I'm pleased to be joined by Barry Martin, the lead portfolio manager for Shelton Capital Management's option overlay strategies. Barry, thanks very much for joining us again.
Thank you for having us. Appreciate it.
So we're going to be talking today about cash flow generation with option strategies. So far this year, the markets have been going up and up and up until I think very recently. We're recording this on September 4th. Had a bit of a bump yesterday, but for the most part this year, indexes are setting record highs. Yet the run in bull stocks hasn't stopped advisors from turning to covered call products. I think categories jumped to $75 billion this year, up from $46 billion last year. Why do you think this is the right strategy now for investors, even with the stock market highs and the higher bond yields?
Yeah, well, a lot has to do with seasonality. Like you mentioned before, we're at all-time highs. And, when we have this appreciation, you're seeing volatility start to creep in the market. Right now, we have the VIX north of 20. So people are starting to get nervous. So this is definitely a good defensive quality. And it's a defensive way to attack owning the market equities. And so what you're doing is as volatility expands, you're selling covered calls. And so you're somewhat hedging your portfolio. So I believe it makes sense, especially given the second half of the year of the unknown of the election, seasonality, and basically the reaction to those things. We don't know what the market will do, and we don't know who's going to win the election. So this uncertainty rises to elevated volatility, and that's where a covered call makes a lot of sense.
Yeah, let's go to that a little bit more. I mean, you touched on market volatility, U.S. elections, rate cuts, geopolitical uncertainty, all this is coming into play. I guess we can expect to see more volatility in the rest of the year. Yeah. How does that specifically impact covered call investing?
Yeah, so when you look at pricing of options, one of the main factors is volatility. So as volatility expands, you actually receive more from selling covered calls. So people really look at this as a couple different ways. Once again, as a defensive strategy, as a hedge. So you're selling calls and receiving more money, but also people are looking at it as an alternative income stream as well. And so what we're doing is generating additional cash flow by monetizing the volatility of these underlying positions. And we do that by selling covered calls. So people kind of look at two different ways. Someone like myself, who's younger, who doesn't need the cash flow, probably is looking more of a defensive play. But then you have other people that, especially with demographics today, people approaching retirement, in retirement, looking for cash flow and looking for alternative ways to generate it. So this isn't your typical dividend play or your fixed income play. It's kind of in between. So it's a little bit different. So that's where we're seeing a lot of people use it, either for a cash flow alternative, or someone like myself who's just looking for some way to smooth out the bumpy ride.
I think most advisors would understand this on the surface level, but can you get into the weeds a little bit about how the covered options that we're talking about here generate cash? How does it work? What are the components at play?
Yeah, basically what we're doing is we're generating additional cash returns by monetizing the volatility of the underlying position. And we do that by selling covered calls. So if we use an example for like Apple's priced around 220. I can sell someone the right to buy Apple off of me at 240 in October. And someone will pay me for that right. So right now that price is around $1.50. So I own Apple at 220. I'm selling someone the right to buy it off of me at 240 in 44 days, and they're going to give me $1.50. Now, if Apple never gets to 240, which is a pretty nice increase right now, if it never gets to 240, I take that $1.50 and put it in my pocket and do that transaction again. If it does appreciate it, you have two choices. You can either sell the Apple at 240, or you can buy the option back and sell another option. So there is really it's an active way to generate cash flow on your underlying equity.
You mentioned Apple, and that's probably a good one for that kind of appreciation would be significant this year. How do you and your team identify the other stocks that you might use for covered call writing?
Yeah, we look at stocks that are at a defensive quality. And what I mean by that is we really look at their downside risk. So when you write covered calls, you have asymmetric returns. And what I mean by that is that your upside's capped, but you have a lot of downside risk. So for example, use the Apple example. When we're selling it at 240, you have a dramatic appreciation, you're capped out at 240. But if Apple drops to 180, you'll still be down 180 minus that $1.50. So we really have to pay attention to that downside risk. So we look at a lot of different metrics, but main things, it's equities that are defensive quality. So to use an example, if the speed limit's 55 miles an hour, when I'm selecting stocks, I'm driving 40 miles an hour, avoiding potholes, because I have to really pay attention to that downside risk. So typically stocks that are market leaders, stocks that generate free cash flow, and large cap equities are the type of equities that we purchase.
And for most advisors, it makes sense to have someone doing this for them.
Right.
Before I let you go, tell me, you mentioned this a little bit, but maybe a little bit more. What clients should advisors be thinking about using this strategy for?
Yeah. So as I mentioned before, demographics, someone that's approaching retirement or someone that's in retirement, maybe someone that's looking for more a conservative nature to owning equities. That makes a lot of sense. But we're seeing advisors and clients move away from the 60-40 portfolio. So typically 60% would be in equities, 40% would be in fixed income. So what we're seeing is people take maybe 10% of their equity exposure and 10% of their fixed income exposure and creating a new slice of the pie. And that's why we're seeing a lot of growth is people adjusting their models and basically looking for more alternative ways for an income stream. And also, it has a different return pattern. So it doesn't necessarily perform like equities and it doesn't necessarily perform like fixed income. But when you add another vehicle that performs differently to your overall portfolio, you're lowering the overall risk. And we feel that's important. And advisors, obviously are looking for the best interests of their clients. And that's where we're seeing most people and advisors move their money into these type of strategies.
All right. Well, fantastic. Thanks very much. Barry Martin, the lead portfolio manager for Shelton Capital Management's option overlay strategies. Thanks very much for joining us.
Thanks for having us.